Okay, we're back. We're going to do the same thing we did before. Same example. We have a parent, we have a subsidiary. The intercompany sale is 200. 100 cost of goods sold. That's the sale price. This is the cost of goods sold. And the subsidiary, of course, picks it up for 200 as a purchase or inventory. And it sells or will sell for a markup of 2 times that amount. And in this case, we took in the prior video, the 2 opposite extremes, one where there was no sales, one where there were sales of all of it. Now we'll take the approach that it's sort of a mixed bag. Let's take the approach that it's half and half. So here, the parent will sell half of what it bought, and since it's marking it up 2 times, so if it'll take half of the 200, it'll sell $200 of sales. To the parent, it's the cost of goods sold of 100. I'm sorry, to the subsidiary. So the subsidiary's books will record this, and this is what the parent records over here. And we want to do the same kind of philosophy as we were doing before, follow the T accounts as they'll end up looking like for consolidation purposes, and then see what it looks like in the final column, the consolidated statement itself. And we've got 3 T accounts to follow: sales, cost of goods sold, and inventory. So following the theory of how we make the adjustment, even if we don't know what we're doing, we can follow the theory of how to make that adjustment just by doing it by rote, as they say, by memory. And the first part of the formula was you debit sales for the entire amount of the intercompany sale. That's 200. Second part of it is you credit the cost of goods sold as it relates to that intercompany sale for the 100. So it's all coming from here. This entry, this is what we start with, reversing all of that. That's cool. All right, the next phase that we do is we say how much sold, because we need to balance this entry, and we're going to balance this entry here. We need a $100 credit, or a combination of $100 credits. To get to a $100 credit, we need a combination of credits to get there. And so we say if half sold, then half of it goes to cost of goods sold for the amount that we need to balance the entry by, which in this case is 50. And if half of it's remaining, not sold, then the other half of what we need to get this entry to balance, which is 50% of $100, goes to inventory, and it's sort of this number that represents the embedded profit. This is the entry we make according to the sheet that we looked at, that one piece of paper, so to speak, and it's one canvas, and how you go about doing it. You always do this. You debit the sales for the full amount of the intercompany sale. You always do this to start. You credit the amount of the cost of goods sold on that intercompany sale, and the difference to balance the entry is split percentage-wise based on the amount of inventory remaining. In this case, it was 50% because they didn't sell 50% of the inventory. So it was a 50% factor that caused us to put 50% here and then 50% here. This amount represents what was sold. This is the amount that represents what was not sold. So let's see now how all this affects the T accounts that are consolidated. Before the entry that we just looked at, what would have shown up in the sales column would have been the 200 of the intercompany sale and 200 from the sales made by the subsidiary, and you can see that right there. This is the sales on the intercompany side, and this is the sales on the subsidiary. This represents the sales truly to the outside world. This is the intercompany amount over here. Nevertheless, when we combine the general ledgers together for consolidation purposes, our T account starts off looking like this. Same theory, our T account for the cost of goods sold will be 100 from the parent side of the intercompany sale, relating back to here. and another 100 from the subsidiary sale to the outside world. The inventory, as far as it will look like, will be the inventory remaining on the subsidiaries books, and that would be 100, because they paid 200 initially in their purchase here, and they sold half of that amount. So in their inventory remain 100. The entry that we make does the following. The entry that we made reversed out the intercompany amount, the 200. That was the debit here. Then we initially credit a cost of goods sold for 100 and then another 50 based on the percentage of the unsold amount to balance the entry. So the total credits came out to 150. The inventory adjustment was 50 here. And you will be amazed at the result that this has. Now this consolidated sales will be a total of 200. Which, looking back to the logic, the sales to the outside world was really just this amount, the amount made by the subsidiary. The intercompany doesn't count. So the only amount of sales that the consolidated total companies together made was 200, and that's proven here. So we can give it our infamous, famous double check mark. The cost of goods sold, now let's take a look at what it comes out to be. It will come out to be 150. And that works out perfectly because the gross profit on the sales of what is half of this initial inventory is what's been sold. Half of that initial inventory is what's been sold. And it's been sold for, so half of that is our really cost of goods sold in total. And only half of, and it's been sold for 200. So the gross profit is 150. That's what the gross profit. If we knew at the beginning of the day we're going to sell half of the original 100, we would have known that whatever we sell that for will equal our gross profit, and what we sold it for which was sold by the subsidiary for 200, means we had a gross profit of 150. And indeed, if our let's see, 200. No, I'm sorry, did the math wrong. Let's see exactly what the T account shows us. The T account shows us that the cost of goods sold is now 50, and that's what I meant. The gross profit has been preserved. Beautiful. How about the inventory? The inventory is now going to be 50 on the consolidated, and again, that's right, just like this is right, because we started off with a original inventory amount of 100, and we sold half of it. The subsidiary sold half to the outside world, leaving 50 on a consolidated basis, and that's exactly what we get. So there's a way to look at it logically, the whole process of this entry. The next step, which I will reserve till next week, because I need to take more medication in order to figure it out, and that will be the logic of the reversing entry the next year. We'll start with our understanding that this is the way it works, logically on the first year, so we don't have to repeat this, and then we'll see why the reversing entry does what it does. Thank you.